Just when we thought the rate cuts were the main character for 2025, the RBA has turned around and said, plot twist. We are back for another Wilson Monthly Market Update on the Money Mentor podcast, here to deliver the information you can use so you can then determine the best strategy for you. Welcome back, Doc. February episode.
Yes, g'day Rachel, and what a month it's been.
Yeah.
Can we fit it all in?
A few more changes than we were expecting.
Well, it was perhaps, but it's interesting that we've sort of entered into bizarro world, haven't we? If we go back a year, of course, we had our first rate cut in, a decade, and here we are a year later, we're giving it back, and perhaps we may have to give back more than just one going forward. But it's interesting, and of course, it does spell opportunity, even though higher rates are not something that homeowners, particularly mortgage owners, welcome. It does present opportunities in the market, because particularly in the short term, confidence takes a hit, and we've seen that already. Predictions that prices will fall, but haven't we heard that all before?
Yeah.
But I do think it's interesting also that through most of last year, particularly when we did have those rate cuts, we were saying, gee whiz, this is pretty interesting. Can we really substantiate rate cuts? 3 rate cuts we had. We had February, we had May, and we had August. And yet our economy was doing well. Inflation was still high. We hadn't reached the target range. And yet, no surprise, it set off a boom in house prices. So perhaps the Reserve Bank has figured, well, maybe we need to take one of these rate cuts back. And of course, that's what happened. But of course, the key now is, where do we go from here?
Yep.
And that's what we want to discuss today. And
we've got a scary outlook. The RBA is saying there might be a few more increases.
Yeah, well, it's scary in that sense, but the data's still very, very positive overall. And if we consider the fact that maybe we had rate cuts that were a little earlier in the cycle than we could have expected, we can understand that this is moderating that. I'm not so sure it'll have over the full year, and of course we don't know what's going to happen in terms of the economy, that it'll have the sort of significant impact on the housing market that many are predicting, as usual. No surprise, It is clickbait. It's probably the best clickbait there is, house prices to crash. So what are we going to look at today? I think that's the big question, and it is the latest housing market news.
Yeah, so we are going to look at the RBA rate increase and insights on where to from here. We do have the latest housing market response to that rate increase as well.
Yes.
And as we've already said, we're not really thinking it's going to impact too much. We do have the new labour market data as well, which is still indicating quite strong.
Hot off the press.
Are rents still rising as well? We're going to have that data. Latest home loan data, investor and first home buyer activity. So we've got a full quarter now of that first home buyer incentives that came in. So we'll talk about that. Our latest home building approvals and house building costs. So definitely not some good news there. Is undersupply still driving the housing markets and outlook for the housing markets in 2026? And
this is the point, Rachel. We're looking at one factor, and that's higher interest rates from lower interest rates. So we're sort of moderating what was a significant boost to affordability. But the big picture is, it's still, we have, in terms of the law of supply and demand, we still have a chronically undersupplied housing market. And the government seems to be shifting to demand modification through a number of policies, and yet 2 years ago it told us it was we were going to have a house building boom. Yeah. And when we look at the latest numbers, which we will do today, that's just not occurring.
It's just not there.
And it's sort of like, oh, that's a bit hard. In the too hard basket, let's try something else.
Let's get it was easy.
Yeah, but the key solution to all of this is just to build more houses rather than take away from one group of housing market participants to give it to another one. And, this just sort of smells of problems down the track, in terms of that manipulation. So shall we have a look at some of the data that has come through? And of course, I don't know if that's being a little cruel to say it was an RBA flip-flop.
Yeah, but didn't they even really admit they got a few things wrong last year?
They did admit
that. We're taking it straight from the horse's mouth.
Well, that's right. And they've increased it by 0.25%. Official rates now are 3.85%. It's the first increase since November 2023. And as we said, it reverses those sharp cuts of last year. even though we've seen those cuts initiated last year, we were still above the RBA's preferred measure of inflation. Now, they kept telling us that their aim was to get inflation to the midpoint of its target range, and that was 2 to 3%. And that was underlying inflation. Now, it never got consistently to that midpoint, 2.5%, and yet we had rate cuts going forward. So it was, as we discussed, it looked a little bit, well, we haven't achieved what the Reserve Bank said that it was after, and that was a consistent midpoint inflation rate, and yet we've had those rate cuts. And of course, you know, I guess you could say it would happen, wouldn't it? And what did happen was we've seen inflation regenerate itself, particularly through higher electricity prices. So it wasn't really higher electricity prices, it was the end of the government's subsidies.
Yeah.
Because, you know, electricity prices were rising through the back end of the COVID period. The government stepped in, gave some very generous subsidies.
But I mean, those short-term incentives, they were never really the answer.
Well, that's right, and this is the point, because they ended, because they're very expensive, of course, and the taxpayer pays for that. And as soon as the subsidies ended, guess what? Electricity prices go up.
Exactly,
guess what? It's a significant contributor to inflation, so inflation goes back up. Now, the government still has subsidies in play, but it's a sort of a subsidies, a Clayton's subsidies, you know, Clayton's light, a subsidy light. But you know, when they end, it's going to again push up electricity prices. So we don't really have an end in sight to higher electricity prices, because look, the transition from the carbon economy to renewables is taking longer and it's costing more than originally anticipated. So the underlying drive is for higher electricity prices. So that's going to be something very difficult to control. And subsidies, as you said, are only a short-term solution. And that's what we're seeing now, that once the subsidies ease, electricity prices go up, and of course that means inflation goes up, and therefore we have the spectre of higher interest rates. You know. And how are higher interest rates going to push down the price of electricity and therefore inflation? I mean, it just makes everything more expensive, as well as electricity costing more. Everything else will cost more. So you know, to me, I think that, you know, because it's not about demand surging, why we're seeing higher interest rates to control demand. It's about trying to control a specific element, and the risk is that we will, you know, we will crack the economy going forward with higher interest rates. So that's why the RBA has to be particularly careful here. Now, you already mentioned the unemployment rate that came out this week. Now, that's the unemployment rate for January. It's the first of the year, and that's very important for the future of, or the shorter term future of interest rates, because as long as the economy remains strong, the RBA will be more confident about raising rates without jeopardising what's happening in the economy. But if we look at what the RBA said in its statement when it did increase rates, it was like, we got this wrong, we got that wrong, we were wrong about that, we were wrong about that. Now, we're not here to bag the RBA, let's get that straight. I mean, it's a very hard job, but certainly they've missed a number of, you know, their predictions have been, you know, they've sort of missed that. And one of of course, is inflation, that's started to pick up. The other thing is they said that they were surprised at how demand had increased. Now, they didn't specifically mention any specific demand force that they'd seen that had increased and, you know, surprised them. But wouldn't you think, if you were cutting interest rates 3 times in, you know, 6 months, that they might just create a little bit of extra demand going forward, you know? But look, as I said, we're not here to sort of bag the Reserve Bank. It's about what's going, you know, what's going to happen now. And I would have thought the Reserve Bank would also have been mindful of what happens when you take the subsidies away. That would push up the cost of electricity and therefore start pushing up inflation. So I guess you're right. We've sort of flip-flopped into a whole different universe now, a parallel universe of higher rates. So we've got
which was somewhat expected, but it was probably a little bit earlier than we really thought.
Unfortunately, rate changes tend to cause disturbances. It's like when you put the pebble in the pond and the ripples move outwards. And you know, I thought we would have a year of steady interest rate, and that was my particular view of.
Well, that's what we said last podcast.
That's right. Yeah, that they would be steady, but. I think the Reserve Bank has clearly decided that, that the risks to inflation were that if they didn't do something, that it'd be like if inflation keeps rising, well, why haven't you increased interest rates when you cut interest rates 3 times last year? But I think the prospects are still very strong for our housing market, notwithstanding what's happening with interest rates.
Well, like we've always said, we've got a housing supply issue.
Well, that's the big picture here.
Not going to go away very quickly.
Yeah, and when we look at inflation, it has been all about electricity, and the latest inflation data was December. So we're sort of looking backwards a bit. We're going to get the January inflation data released within the next week or so. Yep. We'll discuss that in the next podcast. Yep. That will be critical, because if we get another spike in inflation, I think it really does set the scene for another interest rate increase. I'd be surprised if we didn't get another strongish inflation number for January. But we'll wait and see on that one. But I think the scene is set now, and we'll look at the unemployment data shortly, that it's all about the inflation data for January when that's released in terms of another interest rate increase. So when we do look back at the history of underlying inflation, we can see really going back, we never really got to that consistent period at that 2.5% measure.
We didn't get there all of 2025.
Well, we never got to 2.5% period, rather than get it there consistently. Now, we sort of got around about there at the beginning of last year, and then we sort of started to move higher again with inflation, of course. And when you look at the chart in terms of how underlying inflation has moved, it's probably reasonable to suggest, okay, well, it is moving upwards now. It is only 3.3%. So it's not, in a realm, 2.3% is the outside level of the target range. So it's not a lot above that. Yeah. But certainly on that measure and the fact that it's rising, you would expect the Reserve Bank to act, and it has acted, right?
But what more should we be doing other than?
Oh, we can't do anything. How can we? Okay. Can I tell you what?
What are they hoping for?
Okay. This is tongue in cheek. All right. So we could open up all the coal power stations, but that's not going to happen, right?
No.
I'm only joking, but...
we can't go back on what
well, that's right, because they're gone.
Yeah.
Right? What are they doing with them? I don't know. But that's the point. We're into an irreversible future in terms of renewables, right? And there's many positive arguments in favour of that. But the point is, it's going to take longer and looks to be being more expensive.
Well, when are we going to benefit from that?
Well, that's the question.
Yeah.
And if we're going to be in an environment of higher interest rates because high electricity prices are pushing up, inflation, it's sort of, reflects even more of a negative in terms of what's happening with the economy. But we can clearly see that electricity is a significant driver of inflation. Electricity costs actually up over 20% of the last year in the latest inflation data. That's a big rise. Yeah. And that's, a significant contributor to higher inflation. Other factors were reasonably sublime. What is worrying me, Rachel, and we'll look at that shortly, is one of the factors, and we can look at how electricity prices changed when the subsidies changed, how inflation obviously fell when the subsidies were enacted, and of course once the subsidy impact waned, we started to see higher inflation. And it's all about being still above the Reserve Bank's target. But oil, I think, and that's what we should talk about as well. Okay, we've done electricity. We know that's a significant issue and driver of inflation. But what drove inflation prior really to what we've seen with electricity was the price of oil. And of course we had a big spike in the price of oil during the COVID period. Yep. That was a key factor in driving up global inflation. And of course that brought us higher interest rates in 2022. But that's been sort of tracking downwards and hasn't been a significant effect on inflation really over the past year or so. However, we're now starting to see some upward energy in the price of oil. And of course, if we sort of want to get into global geopolitical issues, there's a lot of chat now that Trump's going to, take some military action against Iran. Yep. Now, Iran is a major exporter of oil. And that will, if that does occur, particularly in the shorter term, that's going to push the price of oil up. So we're now looking at, it happens, doesn't it? not only higher electricity prices, but we may get higher oil prices going forward. Now, oil is a much more substantial driver of inflation because there's so many tentacles to the use of oil, and it does push prices up, as electricity does too. So we need to watch out what's happening in oil. But there are two factors, Rachel, that the Reserve Bank looks at. Its brief is to control inflation, right, between 2 and 3%, and the other one is to provide full employment. Now, we've been waiting sort of a little anxiously on the latest employment data. I know you've had sleepless nights waiting for it, but it was the first of the year for January, and it did come out. And I think it was critical because if we had have got a higher unemployment rate, I think it would have tested the RBA's resolve on higher interest rates. So I thought, oh, we better be a little careful here. It's looking a bit fragile, the economy, in terms of the jobs market.
But we're in the opposite at the moment.
And that's the point.
We've got a strong labour
and we had another
right
really good result. And, you know, at the end of the day for housing markets, you know, we talk a lot about interest rates because that's the scary part. You know, you've got to pay more for your mortgage. But the real underlying driver, the fundamental driver, in my opinion, of housing markets is actually the economy in terms of the labour market. Because as long as people have jobs, that they can get a job, their incomes are rising, it fertilises their, you know, their confidence in, you know, in moving forward to, you know, to invest in property.
Pay their mortgages.
And that's the fact that they can do that, you know, because
stimulate
it's the job market there. So that's a good thing in terms of the property market. But in terms of interest rates, this having such a good latest result in terms of the labour market means that it takes a little bit of pressure off the Reserve Bank if they're thinking of raising rates again, because I think, okay, we're not so concerned about the labour market. But the data was very positive, 4.1% again, the unemployment rate. Another big month for jobs, up 17, so we're still creating jobs, up 17,000. Unemployment numbers were also down. They fell 1,900 over the year. And jobs have increased by 1% over the year, but the number of unemployed has actually fallen over the year by 0.1%. We haven't seen that for a while. So we've got fewer unemployed now than we had a year ago.
Which is interesting because it's when you look at that on surface level, it's a positive thing to say that people are employed, they've got money coming in. But then, like you said, it impacts the economy in the way where we go, we're spending more money, so now we've got to increase interest rates.
And that's how it works out with the RBA's thinking, because they think, okay, well, we can be confident that the economy is strong enough to absorb some extra costs in terms of higher interest rates. And as I said, at the end of the day, I think we're just sort of giving back something perhaps that we didn't really deserve that much a year ago.
We all happily accepted it.
Of course, why not? Hey, it's great. And of course, we saw national house prices up 10%. And some markets just really boomed, you know, that Brisbane market.
Because it's easier to get money as well, to lend money, which...
And we're undersupplied, and we have very strong aspiration for home ownership.
But then shouldn't we be rewarding people to do that because we need more houses and people to buy the houses? I know we also need our building approvals up as well, and housing build costs are up too, but shouldn't we be really helping people to buy?
That's harder to do. It's harder, obviously, and we'll look at what's happened with the latest building approval data, which is not good news.
It's not good at all.
It's sort of good news if you're a homeowner, to be quite honest, because it means that housing remains in short supply. But, you know, we want more of a balance. So the temptation to manipulate sub-markets by, you know, giving a leg up to particular parts of the market, thinking that it might help, you know, it might help rebalance the market in favour of a better outcome. I think that's the danger, that we look at demand policies rather than supply policies. And we've never had a problem with demand in this country for property, you know, and I just think it's a bit of an archaic view of the market to be able to do that. But anyway, the participation rate is still steady, so we have a very high participation rate, which means there's plenty of jobs around and people are coming into the labour market, people who perhaps have retired or are self-employed, they've got opportunities. But it's also about, and you know, I don't want to be saying everything's completely rosy, but it's also about people maybe struggling, you know.
They feel forced to put mum back in the workforce,
that's right,
for example.
That's right. And they can, and that's good, but it's because the cost of living is hurting people. So we're not going to paint this as a complete rosy picture, right? But at least the positives are that the jobs are there available to be able to do that. So it was good news there. Western Australia had the lowest unemployment rate of 3.4%. And of course, higher rates will impact a strong labour market at the margin, just as I think those lower rates a year ago helped reinforce it, right? So we need to wait and see what happened then. So when we look at the historical unemployment rate cycle or data, we're still tracking at the same levels as we were during the great mining booms. In
fact, just looking at that, we're almost you can't argue that that data.
That's right. So you can't argue this is a very strong economy.
Yeah.
So it's sort of a good news, bad news story, isn't it? But the stronger the economy gets, the higher inflation goes, the more likely we are to see higher interest rates. And the participation rate, as I mentioned, is also historically high.
So again, almost getting to that 2008 period.
That's right, which was one of our strongest periods in terms of economic activity, and WA the lowest in terms of the unemployment rate. So these numbers are pretty good. Even Victoria, which has struggled recently, has a low unemployment rate, 4.2%. Interestingly, Queensland, the outlier at 4.3%, but not by much, So it's all very consistent there. There's no states that are really struggling and look a little, unusual compared to those other states with low unemployment rates.
Is there a sweet spot of where the RBA wants the labour market to be before they start to feel a bit more comfortable?
Well, they said they were wrong with that because they thought the labour market was starting to tank, and that's another factor that they said that they were wrong in terms of, the labour market. But I think we're at full employment now. I think those unemployment rates that were in the low threes, mid threes a year ago were just, were just too low. They did show a chronic shortage of labour, but I think they're right now. Now, so we've got, in terms of the positives, we've still got a very strong economy. Now we're going to have an interest rate increase, which of course is a cost to mortgage holders and also, impacts confidence. But the other important factor, and this is something that the Reserve Bank would look at, is wages growth.
Yep.
And we're actually seeing two types of strong indications that wages are still growing, which we would expect when you have a shortage of labour and perhaps a full employment economy. So the latest, and this is backward looking a little bit, it's December quarter data. The latest national wage index was up by 0.8% over the quarter, which was the same as September.
Yep.
But we're starting to see wages just pick up a little bit, up by 3.4% over the year. I think we should take this data with a little bit of a grain of salt.
Yeah.
I think the ABS has changed their data in some respect, or their methodology in some respect to this data, because it still looks historically a little bit low when you look at some of the wages growth in previous periods. And I think a lot of this, given we have a full employment economy, you'd think that wages would be pushed up because employers are competing for workers, because the shortage of workers.
Yeah, because again, compare that to 2008.
That's right.
Again, we're not
4%, and we're struggling in the 3%.
Yeah, we're just under 1% of.
I think a lot of this is the impact of the national wage case, which I think skews the methodology a little bit. But if we move to earnings rather than the wages index, and that's the ABS earnings data, so average weekly earnings, we're seeing that quite strong. And this is an important factor in affordability, because it also shows us which states, capital cities, also have an affordability upside, because a lot of the wages, even though there's some disparity there, but you can see there's not a lot of difference between the states in terms of average weekly earnings.
Yeah.
But there's still a difference in prices. So it means that those states, capital cities, that have prices below some others, but their wages are the same, have the capacity to be able to borrow more because they're earning the same sort of money, but they're paying less because prices are lower. Now that's changed a lot in the last 12 months.
Yeah.
Because we're now seeing, a coming together, particularly of Perth, Adelaide, Brisbane and Melbourne.
Well, it's interesting because South Australia now has a median house price of $1 million, just like Queensland and Victoria.
That's right.
But they're still a little bit behind in their earnings compared to those states.
And you know why?
Yeah.
That's happened because they were able to cash in on their higher average weekly earnings.
Yeah.
Because their prices were lower. So whereas it's tougher in Sydney and tougher perhaps in Melbourne, and there are other reasons in Melbourne, those other states, the capital cities in those other states, Brisbane, Adelaide and Perth, had similar earnings but lower prices.
Yeah.
So they could, once obviously generated by higher confidence and lower interest rates, they were able to push up prices. And I think that...
But then can the South Australian economy sustain that if they're still behind on the earnings.
Well, South Australia has actually been a revival state to a large degree in terms of its economy, because it was an underperformer for quite some time, but it's now certainly, even though its earnings are a little lower, its unemployment rate is still low, and I think we know how strong that Adelaide housing market has been. And I think it's not going to be too long before Melbourne is actually the sort of the poor kid on the block in terms of house prices,
which is wild,
of the major capital cities.
A few years ago.
Who would have believed that? I mean, Brisbane's pushing $100,000 higher than Melbourne at the moment, you know, in terms of the median house price. What's going to stop that Brisbane housing market? I don't think a 0.25% interest rate is going to do much.
No.
You know, because it's a bit of a runaway train, that Brisbane housing market, particularly for units. So it's all relative, but I think earnings are important because they show us the relative affordability of each of the capital cities, because the wages aren't that different. And of course, you know, Western Australia typically leads the charge in terms of average weekly earnings. And we've seen very strong growth in that Perth market as well. And when we see the increases, look how these increases, now they're certainly above the wage index increases, which we saw was 3.4%. But look at that, South Australia up 6.6%.
There you go. So they are reacting.
New South Wales up 6%, Victoria up 4.2%. Only Queensland is a sort of an underperformer there, and Western Australia, which is a little bit strange. But the one thing you understand, that Queensland particularly is a much less, it's not all about the capital city there. There's a lot of diversification, a lot of regional areas which don't have the same economic energy as Brisbane and South East Queensland does. So that's why the earnings
is very much competing with Brisbane at the moment.
Well, I mean, I think it's sort of melding into one massive housing market. You know, Greater Brisbane or Greater Gold Coast, perhaps. You know, no offence, but that's certainly occurring. And of course, the energy from the games will only accelerate in those markets. So what's happened up to now? This is okay. So we've spoken about all the issues that have occurred this month. It's been, you know, certainly an interesting month in terms of policy and particularly interest rates. So let's look at the latest data now. February is always, you know, we looked at January in our last podcast. February is always similarly interesting. Now, why is it interesting? Because we still have the energy from the holiday season. You know, so we're counting 3 months here, and that's February, January and December. So obviously there's a lot of holiday energy there where people aren't engaged. There's not as many properties for sale, particularly higher priced properties. But the other factor that we can see, it's interesting that Melbourne and Sydney are underperformers there, both for houses and units. It's because the auction market hasn't started yet. And the auction market is such a big force, particularly in Melbourne, where it makes up around about 25% of all sales. And in Sydney, it's over 20% of all sales, pushing up towards 30%. So that's not active as we speak, particularly through the whole period. So we're waiting for that, and auction activity typically favours higher priced areas. So that's our latest data there. And look, you know, despite the interest rate increase, and it's early days, of course, we're still seeing the big three pushing ahead: Brisbane, Adelaide, and Perth, both for units and houses. So I'm still confident, even early days, and we have water to go under the bridge, perhaps more interest rate increases, that those markets in particular will stand up. So, you know, February data always has that seasonal effect to it, and part of that is the fact, and we'll look at the latest auction data shortly, that pushes prices certainly sideways, particularly in Sydney and Melbourne. Rents are still showing upward pressure. And of course, that's a major factor for investors. You know, so we're now starting to see a real revival in rental growth, which was flat there for around about 18 months, and now clearly starting to rise. And the reason it's rising, Rachel, is we have these incredibly low vacancy rates still. You know, these are crazy vacancy rates, and eventually low vacancy rates, high competition for rental properties will push up rents, and that's clearly what we're seeing now. Auction markets, we've already spoken about auction markets. So what's happened so far this year in auction markets? And the reason we look at auction markets is because, and as I mentioned, Sydney and Melbourne are strong auction markets particularly, is when we track house prices and auction clearance rates, you can see there's a clear correlation between the two. So when we look at house prices, we like to compare them as well to auction clearance rates because they can also tell us what's happening in our markets. And Melbourne's the same story there in terms of clearance rates and house prices. So what's happened? So these are the latest weekly auction results. They move us towards the end of February. It was interesting, we started very strong through January and early February. Some very high results, particularly in Sydney, which had 2 weeks of 80% plus clearance rates. And 80% we regard as a boom time result. Sydney eased a little bit, but the other markets were actually quite steady, even in the face of that interest rate increase, which certainly made headlines and and there was a lot of negativity. Now we're going to see more auctions coming through, particularly in Melbourne. Melbourne has a Super Saturday on the week before the Labor Day public holiday, which is the first week in March. So we see a real surge in auction listings. So that'll test the market, it'll test sentiment. But the other markets too will also have a big rise in listings moving through February. So what did we see in the most recent week? And this is the second week in February. Good numbers of auctions in Sydney, over 1,000 auctions. Good result there overall, 73.9% clearance rate, down from 82.1% the week before, but still, a good result there for sellers generally. Melbourne numbers, as I said, starting to rise. The Melbourne market held firm, just under 70%. Good result again too for Brisbane. Anything over 50% for Brisbane is a good result. It has a different auction culture from the other capitals.
And Adelaide, compare that same week last year, 46%.
That's right.
So it's much stronger at 54%.
So Brisbane, like I said, is it a runaway train? The Brisbane housing market. I think perhaps we could say that. It continues to grow.
Well, we're still a fair way away from the Brisbane Olympics as well, which is quite a huge economical event, right?
Yeah, that's absolutely.
For the area, and to see this growth now before we even have that huge event, it's very interesting.
And Adelaide 80% back to back, so the Adelaide market, which we discussed, still strong. Canberra started the year off quite strong, down a little bit, but that's a good result for Canberra and well ahead of where it was a year ago. And when we look at the trends, we can see that all the markets are ahead of where they tracked at the end of last year and also ahead of where they were at the same month, February last year. A little bit lower there in Melbourne. Brisbane auction market, well ahead of where it was a year ago and also at the end of last year. The Adelaide market, similarly, very strong start to the year in Adelaide, 80% clearance rates. That's, we tend to sort of push Adelaide to one side, but that's a very, very strong market. Boom time results and the same for the Canberra market, tracking ahead of where it finished last year and ahead of where it was a year ago.
It's still trailing behind the other states.
I think there's some issues in that Canberra market, and we discussed some of the local government or state government policies that have perhaps in Melbourne and Canberra impacted the housing markets. We don't want to get too political here, but certainly there's a trend there in terms of I guess comparative house price growth. When we do look at those Sydney, Adelaide, Brisbane and Perth and compare it to Canberra and Melbourne, there's certainly a big difference between the growth through the past 18 months particularly. So if you want those latest auction market results every Saturday night at 6 o'clock, you can get on my LinkedIn channel, which is Doc Andrew Wilson at LinkedIn, the Capital City Snapshot, and Sundays we get the full national report. So let's have a look at some underlying data just quickly, which is supporting the dynamic of our housing markets. We did get the latest home loan data, and that's the December quarter. The interesting there is last year we saw a surge in investor activity. No surprise, higher prices have interested, and lower interest rates particularly have interested investors, and a big move in investors. And also, no surprise, first home buyers up over the quarter by 6.8%.
Got an initiative to take advantage of.
And that'll continue to grow because this is the December quarter, and we've got that incentive also moving into this year. Total home loans up 13.4% over the year. We shouldn't be surprised at that. Let's delve a little bit lower. Well, you can see the energy there for home loans rising. No surprise, house prices rising.
Not a surprise.
Home lending rising. And we can see when we break it down into the elements that are pretty much the same there between owner-occupiers, investors and first home buyers, but investors clearly the strongest over the December quarter. And when we could see the actual data in terms of that growth over the year, 23% increase in investor lending. So quite strong. Just a quick breakdown from the states. New South Wales overall top for home lending over the December quarter. Investor loans also New South Wales tops for investor loans. Victoria in terms of investor loan growth. So that sort of reflects that revival that we saw in investor lend or in the Melbourne housing market.
Also,
it was part of it was investors.
Yeah.
So we can see a big jump in invest, and that's a big rise, nearly 40% increase in investor lending.
So there's still a lot of confidence in that
Absolutely.
market as an investor.
A lot of commitment from investors to that marketplace. And I mean, that also creates economic growth in a state that needs economic growth.
Especially after COVID, yeah.
Well, that's right. And it's been a clear underperformer, that Victorian economy, and not just house prices in Melbourne, So you'd think you'd be nurturing investor activity going forward, and it's just a crazy world where, the talk is about, cutting investor activity for some perceived benefit to first home buyers.
But what's interesting with, talking about cutting that CGT discount, it gives people less incentive to sell.
That's right.
Hold for longer. So then you don't have as much supply in the market for, say, the first home buyers to take advantage of.
And there's no, and I mean, the other point is that surely if you take a benefit away in an environment where, in a free market to a certain degree, an environment where it can be offset by increasing your income source, and that means higher rents.
Yeah.
And investors have the capacity to push up rents because you see how those vacancy rates are crazy low.
Yeah.
I mean, the high vacancy rates are like 1%, and a lot of them are below 1%. So there's obviously very strong competition for rental properties. So,
trying to bring in these initiatives like you can only rise rents once every 12 months. Well, most people sign a 12-month lease.
Yeah, that's right.
So it's really not that long to wait to have to increase your rent.
And that's been rent freezes have been a failed policy in a number of jurisdictions, and I think we've moved beyond that conversation, thankfully. So big rise in Victorian investors. Victoria, as usual, the tops for home loans. Look, there's a very popular policy in Victoria, which is a shared equity with the government for first home buyers, and that has been a very popular scenario. But I think part of that, why that works, is because even though it's been a little soft, that Victorian economy, it's still performing quite well.
Yeah.
And I think the real issue for that shared equity scheme would be if there was a real shakeout in the Victorian economy, and people started to struggle to pay their mortgages and they're in a shared equity situation. I mean, what happens? So, but nonetheless, there's been, Victoria still has the top, as the top state for first home buyers. But interestingly enough, New South Wales has been the top for growth in first home buyers, right? And that's the most expensive state.
Yeah.
And it just shows you that if you can get in, you'll get in, regardless of price. So, the incentives are there, to get into the market without trying to create some sort of a false market environment by pushing away investors and thinking that that'll help first home buyers get into the marketplace. It's an unproven proposition. And as I said, I'm not sure that reducing demand is something that first home buyers would want once they become first home buyer owners, right? They'll want the same sort of capital growth outcomes that their parents and grandparents enjoyed, rather than this sort of Mickey Mouse market where everything's sort of controlled and prices are lower. Would you vote for a government that was going to push down your house price? Well, I'll leave that up in the air. But, certainly that seems to be the nature of the beast. But going forward, now this is, again, this supply scenario. We won't do all the data here, but it's the same old story. We get a higher month and then a lower month for home building. Down by 13.8% after the big rise in November. That's because we get a big month of unit approvals, a big development comes through, and then we don't get the same the following month. So we know that's volatile, the unit data, but houses are a real concern now, Rachel. We're seeing a consistent easing in building approvals for houses, and of course we've seen a big surge in building approvals for units over the last year, particularly in Melbourne and Sydney, that have expedited a lot of planning approvals. Because they know they're under pressure to provide more housing, and that's a good thing because we need more housing. That's the real solution to our housing market balancing itself, is to provide more housing. But the point is with units is it's going to take 3
couple of years
4
to build,
years, right?
And there's still that demand being pushed though. We saw Brisbane up 24% a year on their units.
That's right. So there's nothing wrong with that, and that's good. It's not about, hey, we need to live in a house anymore, because that's sort of moved. It's not the traditional quarter-acre block anymore that, you know, young Australians aspire to. They just want to get in the housing market. Many of them prefer higher density living to the traditional outer suburban sort of lifestyle, beginning their journey.
You said lifestyle. It's not always necessarily affordability. Sometimes it is choice of lifestyle.
Absolutely. And people like inner city living. Brisbane has, you know, sort of regenerated itself and turned into a, you know, a very vibrant inner city culture at Brisbane Market. And that's why we're seeing, you know, skyrocketing Brisbane unit prices. But, you know, we're not seeing, you've got to remember this, okay? So we weren't going to bag the RBA, right? And I certainly don't want to bag the government, right? Because, you know, we're very apolitical here, of course. But we did get a target of 1.2 million houses in 5 years, a couple of years ago. So I think that equates to 240,000 houses a year, or homes a year.
And where are we there?
Well, we'll have a look in a sec, right? Because we'll do a quick math. But certainly the December data was not good. We can see there, yes, units have surged over the past year, but houses are looking just a little bit sick and sorry there. So this is the national home building trend, just flattening out. So the latest data for the month showed us approving 15,000 dwellings, right? So we approved them for building. Now, how's your maths? Is it good? Can you multiply 15 by 12? It gets 180,000. All right, I helped you along there.
Thanks.
So we've had 180,000 on an annualised basis.
So we're behind.
240.
Yeah, we're behind.
Right, so that's a long, long way behind. And these are approvals.
Yeah.
They're not completions.
Yeah.
And typically, you know, we see a lower number, a significantly lower, maybe not significant, but a lower number of completions compared to approvals. So we're really behind the 8 ball in terms of meeting that 1.2 million target that the government set. Now, the government can't build homes. We don't do that anymore at a national level. So it's all about industry doing this, and the government has to facilitate that. So we can't sort of blame the government. But what it shows you is how hard it is to resupply, and there are still a lot of constraints, and, you know, perhaps we need to talk about labour shortages, why we have labour shortages in the construction industry. You know, that's a hoary chestnut going forward. But certainly we're nowhere near matching the target that we need. Now, they set that target understanding that perhaps that was, you know, what we need. So if we're at the time to balance our labour market. So is it any surprise that they're looking at other mechanisms now, like demand side mechanisms, to try to get, you know, more people into the market? So we can see there the trends for both houses and units are falling. After a good start for units last year, Melbourne's still the engine room for building approvals. Sydney's now approving more units than Melbourne. But this is the real, you know, concern, is that when we look at what's happening in the capital cities, Rachael, we can see there that houses in Melbourne, Brisbane and now Adelaide are actually lower than where they were when we compare it to the same time last year. So we're actually building less, not more houses, right, which are a shorter term solution to accommodation needs. And there's the chart that shows us just what's happened to supply over the long period. We're still 25% down on where we were at the peak supply period in 2015-16. And for units, we're down 41% still from that peak period. And look at the trends now. The annual trends are just starting to flatten. So no good news for resupply going forward. Now, we've got another joker in the pack in terms of supply. House building costs are rising. So even if you can get your building approval, it's like, yeah, but the costs are going up. I can't build it. The builder says, the developer says, I'm having a lot of trouble meeting my plan because of rising building costs. And they had started to fall away after that big surge, but now we can see that that's starting to escalate. We saw a big surge in building costs. And that also impacts the inflation rate. But now we're seeing building costs increasing. But annual costs have just eased a little bit over the month, but still up 5.1%. I mean, that's a big number. And when you look back to the pre-COVID period, annual building costs typically were like 1 to 2%. Now we're at 5%. So that's a real concern. And even the ABS and the RBA are conceding that building costs, house building costs are a problem. and we're seeing no relief. And as I said, maybe there's some issues here about the cost of labour going forward. We won't get into that, but it's a very varied picture in terms of supply for not just underbuilding in terms of building approvals, but look at land. I mean, this is crazy. So it starts with the block of land, doesn't it?
Yeah.
And look how high these prices are now. Look at the rise.
Brisbane, 16%.
16%. And we saw that Brisbane building approvals for houses are now 5% lower than they were for the same period last year. So, there's no land, there's no houses, and prices are going through the roof in Brisbane. So this is the other end of the argument when we're talking about a 0.25% interest rate rise following 0.75% cut last year. And this is the real story for the housing market, particularly over the longer term, is we just are not building enough or providing enough land for demand going forward. So let's have a look at the outlook, shall we, and some points here which we've sort of gone through for the housing markets with higher rates. So as we've just seen, housing markets remain chronically undersupplied with both houses and land. House building costs are rising. We still have high migration. It has eased, and I think that was a factor the government thought would help ease, I guess we could say the housing crisis, which has been used, particularly the rental crisis. But migration is still high. As we saw, rental markets are still very tight, very low vacancy rates. Rents are still rising. The government still has significant first home buyer policies, not just the federal government, but state governments. So that's that demand force that continues to come through. And we have, as an alternative, we still have chronically underperforming share market. Even the RBA mentioned that the share market was quite subdued and had been. Investor incentives remain, even though there's talk about reducing some of the investor incentives, there still is negative gearing and of course tax depreciation as part of that. And the real question will be, if there are any changes to capital gains tax at the margin, can you make that retrospective? Would you have to grandfather it, or will you, face the High Court because of retrospective tax policies?
Which I think there will be a very strong reaction to that.
40% of housing is investor owned. And investors vote. Right? So, they're not going to be terribly happy about that. And as I said, there's no clear evidence that reducing investor activity will, mean more opportunities for first home buyers. And first home buyers want to be in a robust market environment, as Australia traditionally has had. And let's remember that back in 2015-16, the banks unilaterally created a credit squeeze against investors. And the same thing happened in 2017 and 18. They actually started to push up interest rates for investors. And what happened? Rents went through the roof. And that was part of that rental crisis that was generated after COVID, was the reduced number of investors in the marketplace. And we've already got a very tight rental market. So, how will reducing investor numbers in the end, for potential first home buyers will be renting, surely, still, and they're going to find it harder to save their deposits if rents are rising, So,
but if we're still seeing strong capital growth in the Australian housing market, regardless, it's not going to deter people from wanting to invest.
That's right.
They're still going to make money.
Yeah, and it's. I don't think it's a good look for government to be introducing tax policies where people have invested in an asset with the belief that they had that tax advantage, and then say, no, it's not here. Sorry, see you later. Right? That's a real impulse. I'm not sure that's the Australian way, to be quite honest, in terms of fairness. But anyway, I digress, and we're not here for politics. So we still have very strong aspiration for home ownership and investment, particularly through a number of demographics. Australia is very much a multicultural country. We have Southern European, we have East Asians, and all those types of South Asian communities that are very strongly attached and recognise, you know, the value in Australia of home ownership for wealth creation and financial security. You know, so there's that undercurrent always of you know, of connection to our housing markets. And look, it's a confidence thing in the early days when we have high, as we've seen, you know, when we look at the cycle, when we have higher interest rates, but it does provide those buying opportunities because people that are, you know, perhaps sit on their hands, oh my God, you know, the sky's falling in, this is Armageddon in the housing market. It's like, well, no, not really, because of all those other factors we've discussed. You know, then take advantage of the sort of the fragile confidence in the marketplace. And we're yet to see that occur. And as I said, I think a lot of these policies, we could describe them perhaps tongue-in-cheek as housing socialism, you know, trying to shift, you know, one part of wealth to another part of wealth or to another part of the community. And I'm not sure that they're, you know, that they're a positive, you know, sort of electoral position, given how strong Australia's connection to housing and housing markets are. As we've seen, incomes and wages are still rising solidly, so affordability is still there as prices are still rising, as well as higher interest rates. And of course, the bottom line is that we have a very strong economy. Low unemployment rate, plenty of jobs being created, and I think, you know, fundamentally that that the economy, as I said before, is the key driver for our housing market. That's the thing we've really got to watch, is the labour market, right? In terms of our housing market performance. So let's finish off and figure out what is going to happen this year, Rachel. Early days, and we'll put our toes in the water, shall we?
We'll give our forecast.
We'll give some forecasts.
We saw a very strong 2025. We ended at 9.9%. Average capital city house price growth, so we're still sitting really strong at 6.8% as an average.
That's right. And when we look at the long-term position, and this is where we've got to take this into consideration when we're talking about the prospect of lower house prices with higher interest rates. What's happened historically? Well, historically, we've only had 4 years where prices have fallen. And it's always been following a very strong period of growth. We saw prices fall the last time we had interest rate increases, and we had an interest rate increase every month through 2022. So, hey, right? And then we saw house prices 4.3%, right? And look what happened before that 4.3% decline. We had a massive increase of over 20% in national house prices. The last 3 years, we've had 25% increase in house prices. I think prices, notwithstanding, and it's very hard now in a fluid environment to, I guess, pick what's going to happen going forward. But I think the positives certainly outweigh the negatives in terms of the outlook for our housing markets. And as I said, 6.3% average over the longer term. So these are my predictions. Obviously, higher interest rates are going to impact and confidence the market, but I still think Brisbane, Adelaide, Perth and Darwin will have positive growth this year. These are midpoint house price forecasts, 7% for Brisbane, Adelaide, Perth and Darwin, 2% for Sydney. Obviously eased a little bit with that higher interest rate. Melbourne up 4%, Canberra and Darwin also. I think the outlier there, perhaps Hobart a little lower. I think Melbourne will make that 4%. I think Brisbane could reach higher than 7% again, but we're talking in the middle. And similar results there for units going forward. So let's wait and see what happens. We don't want to be changing our forecasts too much, because that's not really a forecast, is it?
No, we'll stand strong on this.
I think that's going to be pretty close to the mark. So, and of course, if we talk generally here about capital cities, the national picture. But if you are looking for a breakdown of what's happening on a suburb basis, Rachel, I know you're a big fan of this.
Love the
it's
app.
The My Housing Market Infinity app.
And we've improved it for 2026, so it's even
massive
better.
Now. It's massive. It's bigger than the Bee Gees, if I can say that. Does anybody remember them? Anyway, if you want to get hold of that app, there's a QR code there on the screen, which you can scan. It is managed by Infinity, so the good folks at Infinity will tell you how to access this great app. And what we have now also in the app is the latest news, so you can get the latest property news as part of the app. So we add to that news as it comes through. As you can see, we're just about to put up with that latest data there, what happened with the unemployment rate, and you can also get a link to the latest podcast if you've missed it. So, and it's real property news. It's not what movie stars bought where or with who.
Yeah.
This is about real property news.
Relevant to our
news you can use
audience
and understand going forward, which is what we aim to do in our podcast. But if you're looking for what's happening on a suburb basis in real time, this is the app, and this is a screenshot. You can filter it for price or rent. We're looking here at prices. You can filter it for the state capital city region or the outside capital city region. And we're here looking at Blacktown, big suburb in Sydney. You can filter for house, unit or townhouse. We're looking at houses here, and you can also filter for the number of bedrooms. Does it get any better than that? Well, the answer to that is no. And the answer to that is we can provide the current median asking price, the high and the low, and the number of properties for sale. So these are asking prices. So this is telling you what here and now the market is asking for particular properties. So if you're selling, it helps you provide an insight into an estimate for what you should be asking, I guess. Obviously, this is pitched a little higher than the market because that's what sellers do. But it's a very robust, because it's updated daily, a very robust insight into what's happening at a suburb level. Now, it covers every suburb in Australia, except those that don't have any data, because, you know...
Nothing to report.
Who cares? And it does exactly the same thing for rents. So get hold of that one. And also for investors, we have a breakdown of the top 10 yields in order, the top 10 yields for each of those regions, and also the vacancy rate and the number of properties for rent and for sale, and also a hot link to a map of those particular regions. So it's a great little resource, toolkit for those that are in the property market and who want to understand, particularly now where there's a bit more uncertainty. You can actually, as you're waiting for the next monthly update of the podcast, you can see what's happening. But it's on a suburb basis, so this is really good. So it gives you that granular input. And it's not just the suburb; it's also a breakdown of the particular factors for type of property and the number of bedrooms. So that's it, Rachel. I think we've done very well today. We've covered a lot of data. It is very interesting times going forward now. The next Reserve Bank meeting is on the 14th of March. So we will bring our viewers, our listeners, the latest data on the RBA then. That will be very insightful. But watch out for the inflation numbers for January. That will come out in around about a week's time. But that's the acid test. I think if we get we'd need to get, I think, an easing in the inflation rate for the Reserve Bank to sort of hold off. But I hope we've put the picture together today about the big picture. And it's not just, hey, interest rates have increased. It's about all the factors in housing markets. And, as we've seen now, I'm very confident that we'll see another year of positive growth in our housing markets going forward. Yeah. And are we surprised at that?
No.
No, we're not.
None whatsoever. Thank you so much.
Thank you, Rachel. It's always great to chat. And I hope we've provided a lot of information and insights into what's a very fluid environment at the moment.
Yeah. Well, Doc, you put it perfectly. There you have it, guys. We absolutely cut through the noise. This is news you can use, no clickbait. Until next month, I'm Rachael Howlett.